Good morning, ladies and gentlemen. Welcome to the show. Glad to have you guys here. Now, today is Tuesday, April 2nd, 2019. Thank goodness April Fool's Day is over. I don't really like April Fools. I think it's a silly tradition, just like daylight savings time. Anyway, listen, the world's economy right now is an awful lot more vulnerable than anybody could realize. And an awful lot of things in life happen with timing. It's all about the timing. Ask anybody who's good at telling a joke, and he'll tell you that it's all about the timing. The world's economy right now is extremely vulnerable because of the over-leveraging in the system and the amount of debt that has been created. Now, here's the thing. Let's get right down to it. Let's find our charts and let's open things up right here. And the first thing we want to take a look at is the Baltic Dry Index today. Now, what we notice is, that the Baltic Dry Indexes fell down to a certain point, a certain level in the 600s, and it's been staying there all month. Very low. This is extremely low. It means that there's not a whole lot of world trade is suffering right now. And this is a direct result of what the Fed's been doing. There's a delayed reaction, you see, on the quantitative tightening. And that delayed reaction has actually taken longer to actually put a stranglehold on the economy than any economist thought. They thought it would happen sooner. I thought it would happen sooner. It's a delayed reaction. And this reaction's occurring now. So even if they try to turn things around right now, this reaction will still continue. It's like a train. You can't stop a train immediately. It takes time for a train to roll to a stop. And look at what it's doing to world trade. Now, let's take a look now at the gross domestic product of England, the United Kingdom. Now, you see down here, highlighted in gray, that was the last quarter, quarter three. That was the third quarter of 2018, I should say. And they were just above the zero mark with 0.7%, not quite 1%, a little bit lower than 1% growth. Now, you got to understand, it takes 2 negative quarters to make a recession. Now, in quarter 4, the final quarter, 2018, they dropped from that nearly 1%, 0.7% down to 0.2%. Now, that's a precipitous drop in their final quarter GDP. Now, I've heard that the first quarter GDP numbers are coming in, and I think they're 0.3%. But they could be fudging the numbers a little bit. What the point I'm getting to right now is they're barely above that zero mark, which means recession. Now, what about Germany? Let's take a look at the German numbers right here. And you know what we see? We see 0. Actual, says actual. Right here where it says actual, and then previous, consensus, tell, forecast. The actual is what we're looking at. In 2018, the 11th month, 14th day, we're looking at -2. 2018, on the 23rd day of the month of November, we're looking at negative 0.02%. Now, it went up to 0% in 2019 by the 2nd, February 14th of 2019. It was at 0%, and it's still at 0%. So, now if we take a look at this teleforecast, TE forecast, this is for their forecast into the future for their GDP, and you look how rosy it is. They're giving themselves 0.01%, 0.01, and 0.03. In other words, they're saying, hey, you know what, things are going to get better. But these are projections into the future. And this is the way they keep things going. This is the way they keep kicking the can down the road, is by projecting into the future brighter and rosier, and things are going to get better. And they've been doing this for a long time when things are only going to get worse. Now, I was predicting a few months ago, going back in time, that the whole Brexit thing was pointing toward them falling out of the European Union with a hard Brexit. I thought it was going to happen on March 29th. Well, they postponed it. It's 10 days from now. And it's looking more and more likely that that's what's going to happen. The markets have not priced this in. Let's take a look here. London real estate suffers the largest drop in a decade. So the real estate bubbles are popping. And, you know, London real estate, this shows the condition of the English economy. If they have a hard Brexit, they're definitely going to fire them into a recession. And here's the thing, guys. By the time they declare that the recession is on, it's already started now. By the time they actually declare it, they wait months and months and months, and then they say, oh, by the way, we were in a recession. Yeah, the recession is starting. And it's the cumulative effects of the quantitative tightening is just hitting now. It's hitting right now. And the economy is extremely vulnerable right now. So now let's take a look here at, we're going to get into the charts this morning, and we're going to talk about silver. We're seeing silver bounce back a little bit right now while we speak, but it's down below $15. And I know an awful lot of silver enthusiasts are really sad and depressed today after seeing this price drop from the $15 range down into the 14s. Now, some of you are happy because you want to stack more, but most of you are a little bit depressed because this has been a very depressing market for a very long time, and it's been suppressed for an extremely long time. There's an extreme amount of pressure on this market, silver and gold. Let's take a look at gold today. $12.88. That is just sick. Sick. It's not even up to $1,300. $12.88. You know, there's mining production costs. All-in mining production costs on gold is about $1,100, and on silver is about $14. Let's go to silver again. It's about $14. Now, what did they do to the miners just now? Well, yesterday it was riding at about $15 and say 15 cents. Okay, so that means they had $1.15 of the silver miners had about $1.15 worth of profit. That was their profit margin. Well, today, all of a sudden, that profit margin has been eroded by like 25%. So where's their profit? Now, you got to understand something. It's not easy to get an ounce of silver. They've got to mine out hundreds of pounds of rock. They got to dig out big rocks, boulders. And then they have to run them through rock crushers. They run them through the first rock crusher, crushes them down to a size about 4-inch. I think they call it 4-inch oversize, the first rock crusher. Then they run it through, they have it go up a conveyor belt, and they run it into a second rock crusher, which crushes it down to like 1 inch. Then they have it run up another conveyor belt, and it goes through another rock crusher yet, which crushes it down to like pea size. And then they have to crush it the last time, and they crush it right down to powder. They have to crush it right down to powder. This is what they do. They have to crush hundreds of pounds of rock into powder. Then they have to put it in a big vat and add acids and chemicals, and they have to like stir it in there, and then they have to strain it, and then they have to cook the whole thing down in a big giant smelting ovens and get it down to where, and it only takes a little tiny thing of silver like that. All of that, hundreds and hundreds of pounds of rock. Well, all that rock is processed with diesel fuel. Right? And then there's wear and tear on the machinery. Okay? Then they have to buy new machinery from time to time. They're not really taking in those account of those costs. An awful lot of miners say, oh, our mining, we can do it for $9 an ounce. Yeah, but they're not taking in the account of the costs of replacing the machinery. They're not taking in the account of costs of what's going to happen when that vein of ore that they're digging out starts to decline in its productivity. In other words, there's not as many ounces per ton. They're not taking into account further discoveries to keep their mine going. They're not taking into account the wear and tear on the machinery and the rising costs of diesel fuel and everything else they need to keep the mine going. They have to go into a hardware store just like we do to repair things when things break in the mine. And have you ever noticed how the prices are going up on goods in the hardware store? Okay, these costs are transferred onto the mining corporations and the mining companies, and that price per ounce keeps going up and up and up. Now, they like to estimate their price per ounce low because it helps them to fuel new investment in their mine. And they tend to cost cut, to say, okay, it's not, but in actuality, in reality, in the real world costs for getting that out and turning it into an ounce of silver that you buy at a place like Atmex or Kitco, that's about $14. And I'm telling you, they're cutting it awful close right now at $14.97. With the cost of diesel fuel rising, they know this. Why do you think it's bouncing back this morning? And listen, for you guys that why do you think the price is bouncing back this morning? They know how low they can take it. These guys that play this paper game, they could take it down to zero if they wanted to. They have that kind of power with the paper market over silver and gold. But they do not want to shut down the miners because this game would be over. So they just give the miners just enough cut so that the miners are still out there working and keeping those mining machines going. Because where do you think all of the production that they sell you when you buy that coin at Atmex, it's coming off of mining production. That coin's come right out of the ground. Probably before you bought it 3 or 4 months earlier, that coin was probably down in the ground someplace. That's where it comes from. The Tooth Fairy doesn't bring your silver to Kitco. It's the miners. Right? And so here's the thing. Mining production has to cover all of the industrial demand. That takes most all of mining production. Almost all the mining production is gone. And then they have coin and bar demand on top of that. Has to come out of mining production. It doesn't come from the world inventories of people that are holding silver. I know there's hordes of silver out there that's being held in people's hands tightly. They're not selling it. Don't pay any attention to those numbers when you hear there's like 7 billion ounces of silver out there and stuff. That's all being hoarded, and they're not selling. They're not going to sell at these prices. You might have some silver right now. Would you sell at these prices? So all of that silver out there, those massive quantities of silvers, that doesn't count. What counts is the mining production. And by the time they supply industry, and by the time they supply coin and bar demand, there's none left. There's none left available for sale. Unless they dip into world inventories. Now, they're keeping those numbers real secret, what's left of world inventory that's available for sale. Those numbers are real secret. But it's not very many. There's not very much left. Okay, so there's where we stand. And we could actually have a silver shortage because what can happen is if coin and bar demand were to shoot through the roof because of some crisis out there and people are scared they're buying silver, there'd be a failure to deliver. Immediately the price would shoot to the moon, and it will not stop until it reaches a price where it satisfies these people and they start to come in with their silver hoards, you know. People that are holding silver, they start to come in and sell. Then it would end. The shortage would end because there'd be silver flooding back into the market. But how high would it have to go before the average stacker would decide, hey, you know, honey, I'm going to go in and sell some of my silver because the price is really up today? I'm going to tell you what, it'd have to go up a lot higher than it is right now. I can tell you that right now. Okay, so you silver guys out there, do not be depressed. Do not be discouraged. Be patient. Be patient. Now let's take a look at cryptocurrency today. Cryptocurrency today is at $4,804. It's up today. Now, I'm going to tell you something about this. Right now, this market is not back in a bull market again. It's still in a bear market. And in fact, there still is the possibility, even though it's a little bit more remote now at this point, that it could actually test new bottoms. So do not get excited about this. Cryptocurrency's up. Do not get excited. It's not back in a bull market yet. Okay? But we have seen some gains in the market, and it's nice to see. Anyway, here on cryptocurrency market capitalizations, we see the market cap is now up to $163 billion. It's gained like $20 billion in market cap. 51.4% Bitcoin dominance, and all the coins are shooting to the moon. We're seeing Bitcoin at $47.74, Ethereum at $156, XRP is at 33 cents, 33.8 cents. Litecoin is at $69.63. EOS is at $4.65. Bitcoin Cash is $193.94. Binance Coin is $19.15, and Stellar is 11.9 cents, and Cardano is 8 cents apiece. Okay, so there's our top coins, and that's what's happening there. Dow Jones Industrial Average today. She's down 77 points on the day. Now, the market has not realized in and has not priced in a hard Brexit, which would trigger a recession in the United Kingdom. And if a recession is triggered in the United Kingdom, it's going to trigger itself in Germany too, because they're trading partners. Germany right now is just barely above zero on the recession line. It wouldn't take much to just 1 point down, and they're in the recession, Germany. And believe me, if trade between them and England dries up, they're going to lose that 1 point, and they might lose 2 or 3 points. The whole world's recession. Then if Germany goes down, then triggers France to go down into a recession, and the recession starts to spread from country to country like a plague. Now you have to understand, even though the Fed's going to end their quantitative tightening, the damage has already been done. The damage is already done. It's already there. Okay, so now let's take a look at the crude oil price. 61.86. Crude oil is shooting up today. It's up 27 cents on the day, 0.44%. But 61.86 is riding high. Boy, OPEC has a lot of power. Okay, now let's take a look at the U.S. Treasuries today. And we've gone back into our slide again. The Treasuries are going back, heading back toward what they were doing when we get an inversion in the yield curve. Well, we're heading back into the inversion again. We came out a little bit yesterday, but today we're sliding back into the inversion. The stubborn one is the U.S. 30-year. And when that 30-year inverts, then we've got all the way across the whole length of the table then at that point. Sure sign of recession coming. Now let's take a look at the U.S. dollar index for today. 97.36. And so the dollar is up today, and this is one of the reasons why gold and silver are down. This dollar's staying strong, you know, and this is the effects of quantitative tightening. That's what's helping to hold the dollar up. So listen, thank you guys for watching my show, and you know, have a real nice afternoon, and thank you for watching, and give me a thumbs up, and we'll catch you on the next show. Bye-bye, guys.